This figure of 30 million barrels a day, given the state of the economic outlook at the moment, do you think this is a fair enough figure that they can manage between now and June next year?
Well, I think it is good that they've sent this message. I think this is a solid figure. What they're basically saying is what OPEC member countries are currently producing, that's fine. We'll leave the production where it is, but it's more of a restriction on future production, which I think is from the whole group as a whole, which I think is wise because we're going into an environment in the next couple of quarters where growth is decelerating globally, and the question is oil demand growth going to continue to be strong? So if you see global growth slowing, you could see oil demand growth slow a little bit, so there's downside risk on demand, and so what they're doing is they're addressing that by saying, okay, we're going to limit supply somewhat. We're not going to ramp it back. It's not going to be a decrease. We're just going to hold it steady because we want to see how the slower growth plays out. I think that's a very strong and positive reaffirmation to the global oil markets that they're paying attention, that they're cognizant of these risks, but I think it also highlights the fact that the downside risk to growth is real.
Now, when we look at the consumer groups, many of them saying that the high oil price, a sustained high oil price, will be bad for the economy. OPEC members don't want to see that, but at the same time, we're hearing loud and clear there from the Secretary General and indeed from many of the ministers that this is what he calls a comfortable price, good for the producers and good for the consumers, and again, that will encourage and hopefully maintain investment. This is hugely important in terms of the investment to keep going.
Well, this is very, very critical because while we can see short-term moves in the price lower, if OPEC were not trying to constrict supply, the prices could move sharply lower, and all that does is exacerbate the price moves higher in the medium and longer run without significant investment. I'm not worried about whether the price of oil in 2012 is going to be above or below $100 a barrel. I think it'll be around that for Brent, but that's not what I'm worried about. I'm worried about what the price of oil will be when growth picks up again in 2012 and 2013 and beyond. And I think most people, when they look back 5-10 years from now, they're going to think oil was cheap now. And the only thing that can prevent that from happening really is to continue to invest in oil upstream infrastructure, to continue to invest a lot in new production, increasing production, improving production. That's really critical right now for the medium and long term. And by keeping the prices where they are, by keeping supply somewhat constrained, OPEC's addressing that issue.
And of course, that harmony within OPEC that we've seen so much of, and maybe we had a little bit of a blip this year, this is absolutely crucial, isn't it? I think that sends a very clear message to the market.
Yeah, I think it does, that OPEC's working together on this. And of course, coming into this meeting, there's always a chance when there's downside risk, the group's going to be more apt to work together. And I think right now the downside risks are greater to price. And there was a real need for cohesion, a real need to send a unified message that we are on top of this. And I think that's what the communique does.
So now there is that unity in place. They're all looking ahead to the year to come. What do you think will be the big stumbling blocks? What are the main things they need to be looking at?
Well, I think they're already looking at growth. I think there's a potential further downside to growth. What you could see is that oil demand remains solid, but oil prices still get pushed down regardless of what the supply situation looks like, because you have a psychology in the markets where the nuance difference between 2012, you see a little bit slower growth than in 2011, but it's still positive growth. It's a deceleration. It's not negative. It's positive, but less positive. It's a second derivative problem. And if the markets get a hold of that, investors, the media, and everyone else looks at this, and the story might not be growth is slowing. It might be we're returning to another recession. We don't think that's going to happen, but it doesn't matter because that might be the story that runs in Q1, Q2 when we see worse European data and we see worse Chinese data.
But you're pretty confident that we're not really heading into a recession, and once again clarified, you're talking about deceleration.
That's right. It's a deceleration of growth. We still see the growth rate for next year globally being somewhere between 2 and 3% for global GDP. This year it was between 3.5% and 4%. It's a little bit slower. It's not great growth, but it's positive. It's tepidly positive, and I think the risk is to market sentiment rather than to actual physical demand.
Super. Jason Schenker there from Prestige Economics. Thank you so much, Jason.